Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Rocket Lab.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Right.
So today we are generating a complete audio summary for you on Rocket Lab. And let's just unpack this right away because the numbers we are looking at today are, well, they're staggering.
They really are.
But they also raise some pretty serious questions. I mean, we're looking at a stock that surged over 260% in a single year.
Yeah, a massive run.
And we're also looking at a recent $816 million government contract, plus a backlog of future work sitting at nearly $2 billion.
It is a totally different landscape now.
Right. Because for a long time, the space industry was seen as just this playground for billionaires burning cash on totally speculative projects. But looking at these figures, it seems like we are finally entering a phase of true industrialization. So the question for you, the listener, is whether this is an actual wealth-building opportunity or if that recent double-digit pullback means the bubble is, already bursting.
And that is exactly the right lens to view this through. For years, allocating capital to the space sector felt a lot like venture capital investing.
Very high risk.
Exactly. You were essentially buying a compelling story and just hoping they didn't run out of money before the technology actually worked.
Right.
But the data we are parsing today shows a really clear transition. We are looking at a company that is shifting from that high-risk speculative phase into a predictable revenue-generating operation.
But as I hinted at, it's not exactly without turbulence, right?
Oh, definitely not. To understand the underlying value here, we really have to look past the rocket launches themselves and understand the entire supply chain they are trying to corner.
Yeah, and that makes sense because when I started looking at their fourth quarter of 2025, the growth didn't seem to be coming just from shooting rockets into the sky.
No, not at all.
They reported $180 million in revenue for Q4 alone. That is a 36% jump compared to the same time last year. And their full-year revenue for 2025 actually crossed $600 million.
Which is huge.
Right. That kind of 38% annual growth usually makes Wall Street pay very close attention. But if you break down where that money is actually coming from, it seems like the narrative of them just being a delivery service is completely outdated.
Completely outdated. Honestly, if you take away anything from our analysis today, it should be the evolution of their space systems segment.
Break that down for us.
Well, the general public still pictures their Electron rocket sitting on a launch pad, but the launch vehicle is merely the delivery truck.
Just the truck.
Right. The real margins, the real sustainable wealth-building engine, lies in manufacturing the high-value cargo inside that truck.
Oh, I see.
The anchor for this recent revenue surge is that $816 million contract with the Space Development Agency.
The SDA.
Exactly. They aren't just giving 18 satellites a ride to orbit. They are building those 18 satellites from scratch.
Wow.
They are manufacturing the chassis, the flight software, the star trackers that navigate by looking at constellations, and the reaction wheels that physically orient the spacecraft in a vacuum.
So they are essentially becoming an end-to-end prime contractor.
Yes, exactly.
They aren't just operating the freight train. They're building the cargo, the train cars, and writing the logistics software to go with it.
That is the perfect way to put it.
That fundamentally changes the floor for their revenue, doesn't it?
It absolutely does. Selling a rocket launch is a solid business, sure, but building the multi-million-dollar hardware that goes on top of it, that vertically integrates the revenue stream. And you can see it clearly showing up in their profitability metrics.
Well, let's scrutinize those metrics then. Because growth is great, but not if a company is selling $1 for 90 cents just to show revenue on paper.
Right. Profit matters.
Exactly. In Q4, their GAAP gross margins, meaning generally accepted accounting principles, which is the strictest, no excuses way to look at the books, expanded to 38%.
Very healthy.
And if we look at non-GAAP, which strips out some of the one-time or non-cash expenses, it hit over 44%.
Incredible numbers for aerospace.
Plus, the earnings per share loss was only 9 cents. That means for every share outstanding, they lost a penny less than the 10-cent loss Wall Street analysts had actually braced for. They are really tightening their belts.
It is the classic footprint of a hardware company achieving economies of scale.
How so?
Well, when you first design a rocket or a satellite, the research and development costs are just astronomical. But as you build your 10th, 20th, or 50th unit, your factory floor gets incredibly efficient.
You work out the kinks.
Exactly. You figure out how to machine parts faster, you streamline your supply chain, and your margins naturally expand. However, and this is important, if you are closely tracking their guidance for the first quarter of 2026, you might have noticed a slight wrinkle.
Yeah, I did see that. They projected revenue between $185 and $200 million, which is excellent, but they also noted that gross margins might dip slightly to the mid-30s.
And that right there is exactly what trips some people up.
Right, because I wanted to challenge you on that. If they have all this momentum and these newfound factory efficiencies, why are they telling investors to expect a drop in margins right out of the gate in 2026? Does that mean the efficiencies are already maxing out?
It is a totally valid concern, but you really have to look at the product mix. The reason for that projected dip isn't lost efficiency. It is a higher volume of government space systems revenue.
Okay, explain how that changes the margin.
When you build spacecraft for defense or government agencies, the contracts are highly lucrative in absolute dollars, but the percentage margin is typically a bit lower than a purely commercial, dedicated rocket launch.
So they make a smaller percentage, but on a much bigger pie.
Precisely. The margin percentage shrinks slightly, but the sheer volume of actual profit dollars hitting the balance sheet is substantially larger.
Got it.
It is a trade-off that is highly beneficial for long-term financial health.
Speaking of financial health, looking at their balance sheet is almost startling for an aerospace company.
It really is an outlier.
They ended 2025 with $1.1 billion in cash and equivalents. A war chest of that size in an industry literally known for bankrupting billionaires seems like a distinct strategic advantage.
Massive advantage.
But why hold on to that much cash? Why not return it to the people listening right now in the form of dividends or stock buybacks?
Because of a concept that every growth investor needs to fiercely guard against shareholder dilution.
Ah, the dreaded dilution.
Exactly. Aerospace hardware development is brutally expensive. Historically, companies in this sector frequently burn through their cash reserves while trying to finish their next big rocket.
Right.
And when the bank account runs dry, they are forced to issue millions of new shares to the public just to raise funds to keep the lights on.
And when they do that, the shares I already own lose value. It's like slicing a pizza into 20 pieces instead of 8. The pizza didn't get any bigger, my slice just got much, much smaller.
That is a perfect analogy. Massive dilution has ruined so many promising tech investments over the years.
It really has.
But with a liquidity buffer of over $1 billion, this company is essentially insulated from that risk right now. They can fully fund the rigorous testing and development of their upcoming larger Neutron rocket without needing to dilute your holdings.
That is a huge relief for anyone holding the stock.
It is. They are intentionally reinvesting their cash into high-return growth areas, like expanding their satellite production lines, because the return on capital for those projects vastly outweighs the benefit of a small dividend.
Makes total sense.
For an investor, knowing that war chest is there provides a tremendous safety net while the company executes on its backlog.
And we really need to dig into that backlog because it is sitting at $1.85 billion.
Up 73% from the previous year, by the way.
Which is incredible.
Yeah.
But the part that stood out to me in the research wasn't just the sheer size of the number, it was the timeline. 37% of that backlog is expected to convert into recognized revenue within the next 12 months.
Which means nearly $700 million is already spoken for over the next year.
That is amazing visibility.
It provides incredible cash flow visibility. In the stock market, uncertainty is penalized and predictability is rewarded.
Always.
Having that much locked-in revenue allows management to make long-term strategic decisions rather than scrambling quarter to quarter just to make payroll.
But, having a lot of cash and a big backlog is only half the battle. They still have to actually beat the competition. And when most people think of commercial spaceflight, they immediately picture the heavy-lift, reusable rockets owned by a certain high-profile billionaire.
We all know who you mean.
Right. So how does a company focused on much smaller rockets carve out a lane against a competitor who can literally haul a school bus into orbit?
It really comes down to understanding the difference between a city bus and a private taxi.
Okay, I like that.
The heavy lift competitors focus on rideshare missions. They pack dozens of satellites from different customers onto one giant rocket. But just like a city bus, you get dropped off at the general orbital neighborhood they choose on their schedule.
So if I need my satellite in a very specific spot.
If you are a commercial client or a defense agency that needs a satellite placed in a highly specific bespoke orbit and you need it there next Tuesday, The rideshare model simply doesn't work for you.
You need a taxi.
Exactly. By dominating the underserved small to medium lift niche, they offer dedicated precision delivery. Just look at their Electron rockets record for 2025. 21 missions, 100% success rate.
I do want to interject a quick note of caution there, though.
Go ahead.
A flawless record is incredible, but we have to remember that orbital mechanics are incredibly unforgiving.
Right.
One tiny faulty valve, one sensor anomaly, and that flawless record goes up in smoke. In aerospace, past perfection doesn't guarantee future success.
That is a crucial point.
Yeah.
And it is exactly why their true competitive advantage, their actual moat, isn't just the reliability of the rocket.
What is it then?
It is the concept of high switching costs. Remember earlier when we talked about them building the satellites, the software, and the components?
Yeah, the end-to-end stuff.
Right. When a customer designs a satellite to integrate perfectly with a specific company's launch vehicle and flight software, it takes years of engineering.
It sounds a bit like trying to rewire your entire smart home. Imagine switching everything from Google to Apple, but you have to do the rewiring in zero gravity while traveling at 17,000 miles per hour.
That would be a nightmare.
The headache and the cost of changing platforms would be astronomical.
That is the perfect analogy. If a defense contractor wants to switch to a rival launch provider, they have to redesign their payload interfaces, rewrite their communication software, and undergo entirely new, rigorous safety certifications.
Oh, wow.
It is phenomenally expensive and time-consuming to leave. Because they build the satellite components and provide the ride to space, they lock the customer into a vertically integrated ecosystem. Once you are in, the friction to leave is incredibly high.
That definitely clarifies why that $1.85 billion backlog is so sticky. Customers aren't going to just cancel an order on a whim.
Never.
Now, we need to talk about the stock's technical price action, because I am sure anyone looking at a chart right now is experiencing some major whiplash.
Unquestionably.
We talked about this incredible surge earlier, over 260% in a year, peaking around $72. But recently, we've seen a monthly drop of about 16.5%.
Sure.
You mentioned earlier that this might not be the bubble bursting. But if I bought near the top and I'm looking at a double-digit loss, it sure feels like a burst. How do we differentiate between a panic sell-off and normal market mechanics?
It requires looking at the flow of capital and market psychology. A 260% surge is what technical analysts call a parabolic run.
Straight up.
The chart literally looks like a rocket taking off. When an asset moves that aggressively, institutional investors, hedge funds, and early retail buyers find themselves sitting on life-changing multi-year profits in a matter of months.
So they cash out.
Exactly. A 16.5% drop following a strong earnings report is classic profit-taking.
So it's essentially people cashing in their winning lottery tickets, which temporarily drives the price down just due to basic supply and demand.
Exactly. What you want to look for during a pullback is the underlying structure. Is there panic in the order books? Are there massive volume spikes on red days indicating that large institutions are abandoning ship?
And are there?
The data indicates they are not. Instead, we are seeing psychological support forming right around the $68 to $69 level. The market is just digesting those enormous gains, establishing a new foundation, and waiting for the next catalyst.
But let's be totally fair and balanced for the listener. There is a bear case here. It isn't all sunshine and flawless launches.
No, of course not.
The primary reason we saw that profit-taking, and why financial media recently labeled the stock sentiment as neutral, is the delay of their next-generation rocket. The Neutron, which is supposed to be their medium-lift, reusable answer to the competition, has had its timeline pushed back to late 2026.
And we cannot gloss over that. A delayed product launch is a legitimate headwind, especially when that product is central to their future growth narrative.
The market despises uncertainty.
It absolutely hates it. That delay, coupled with the fact that they are still reporting net losses during this heavy investment phase, they lost roughly $53 million in the fourth quarter, created a perfect storm for short-term traders to sell the news. The financial headlines focused heavily on the delayed rocket, which frankly overshadowed the incredibly strong revenue beat from their satellite division.
It creates a fascinating disconnect, though, because while the headlines and the short-term traders were hand-wringing over a delay, Wall Street analysts were doing something entirely different behind the scenes.
They were buying.
Well, Cantor Fitzgerald, for instance, not only maintained an overweight rating on the stock, but they actually raised their price target from $72 up to $85 in late February.
Yes, they did.
If the rocket is delayed, why is Wall Street raising the target? Are they just drinking the company's Kool-Aid?
Not at all. Institutional analysts know that aerospace development programs almost always slip to the right on the calendar. Hardware is hard.
Delays are expected.
Delays are practically baked into their financial models from day one. What wasn't entirely baked in was a 73% growth in the backlog and the rapid margin expansion in the space systems segment.
Oh, I see.
Wall Street is raising targets because the baseline satellite and component business is performing so exceptionally well that it actually de-risks the timeline of the new rocket.
Interesting.
Because they have that billion-dollar cash buffer, they have the luxury of time to get the engineering on the new rocket right, rather than rushing a flawed vehicle to the pad just to appease short-term traders.
Okay, so if we are looking ahead, what should you, the listener, be putting on your calendar? How do we track if this thesis is actually playing out over the next few months?
First, you want to watch for their Q1 2026 earnings, which should hit in late April or early May. The consensus is looking to see if they can beat that projected revenue range of $185 to $200 million by efficiently drawing down their backlog.
Got it.
Second, keep a close eye on any press releases regarding qualification milestones for the delayed rocket.
Right, because even if the launch isn't until late 2026, they aren't just sitting on their hands. They will be firing test engines, pressurizing tanks, and testing avionics throughout the spring.
Exactly. Every successful engine hot fire or tank pressure test chips away at that bear case uncertainty. Furthermore, the Space Symposium is happening in April 2026.
That's a big deal.
It is the premier industry event where defense and commercial entities gather, and major contracts are frequently announced. Given their recent momentum with the Space Development Agency, any new defense contracts announced around this symposium could serve as a substantial upward catalyst.
We should also touch on the macro environment quickly, because stocks don't exist in a vacuum. We're seeing a distinct rotation of global defense spending into space infrastructure. The government isn't just buying one or two giant spy satellites anymore. They are building what's called a proliferated architecture in low Earth orbit.
Which is really just a complex way of saying that instead of relying on $1 billion satellite that an adversary could easily shoot down, they want a swarm of hundreds of smaller, cheaper satellites working together in a network.
Yeah.
If one goes offline, the network survives. But to build and maintain a swarm like that requires constant, ongoing manufacturing and dedicated launches to replenish the constellation.
Which plays directly into the strengths of a company that builds small satellites and launches small rockets.
Precisely.
And combine that defense spending shift with the broader economic potential for interest rate cuts. Historically, when rates drop, capital flows aggressively back into well-capitalized growth stocks because the cost of borrowing drops and future cash flows become way more valuable.
If we pull all these threads together, the macroeconomic tailwinds, the fortress balance sheet, the expanding margins, and the undeniable stickiness of their ecosystem, it leads us directly to the final investment thesis.
The moment of truth.
Looking at the data objectively, we assign this an 8 out of 10 bullish score.
An 8 out of 10 is a very high conviction rating. So bring it home for the listener. If someone is reviewing their portfolio allocations today, how should they categorize this opportunity?
The core wealth building narrative is that you have a rare opportunity to look at a company generating nearly 40% top-line revenue growth, sitting on a near $2 billion backlog of guaranteed work, with an undisputed moat in an expanding defense sector.
That is a powerful combination.
It is. You are getting the chance to evaluate an entry point during a healthy technical consolidation around the high 60s, while major institutional analysts are modeling targets in the mid-80s and beyond. However, and this is critical, you must align your time horizon correctly.
Yeah, this isn't a quick trade to make a few bucks by Friday.
No, it is a multi-year hold. You are positioning yourself now to capture the value of the margin expansion occurring today, with the goal of riding the wave into the operational era of their next-generation rocket in 2027 and beyond.
So patience is key.
If you have the patience to weather the typical aerospace volatility, this post-pullback entry offers a highly compelling risk-to-reward ratio for long-term compounding.
It is about letting the fundamentals do the heavy lifting while the company executes. Well, before we wrap up, I want to pivot away from the balance sheets and the charts. You always leave us with a broader perspective to chew on. What is the final thought you have for the listener today that maybe wasn't covered in the analyst reports?
I want you to step back and think about the geopolitical implications of standardization.
Standardization. Okay.
We talked about how their end-to-end ecosystem, building the software, the components, and providing the launch is creating inescapable switching costs for their customers today. But what happens to the global balance of power in space infrastructure if a single company's hardware and software become the absolute default standard for low Earth orbit?
Wow. That's a big thought.
We're all so focused on the billionaire space race to build the biggest, loudest rocket. But history shows us that the real power doesn't always go to the company that builds the biggest ship. It goes to the company that invents and patents the shipping container.
That is fascinating.
Could the next multi-trillion-dollar space economy be dominated not by whoever lifts the heaviest payload, but by whoever creates the most perfectly integrated, inescapable supply chain that the rest of the world is forced to adopt?
That is a profound way to look at it. It shifts the perspective entirely from thrust and fire to owning the invisible infrastructure of the future economy. That is definitely something to ponder as you review your strategy this week.
I think so.
Thank you all for joining us on this vital analysis. We hope this helps you navigate the markets with more confidence, clarity, and a healthy dose of critical thinking.
Knowledge is most valuable when understood and applied. Keep questioning the consensus and stay focused on the fundamentals.
Be sure to subscribe, leave a like, and comment below on what you think about the industrialization of space. Until next time, keep building that smart wealth.